All right, everybody, welcome back to the Cashflow Chronicles. I recognize it might be slow, people moving in. I know Amit is deciding to do a Q&A after everyone left, so he's probably holding some people up. But either way, we are here, and we are ready to talk about investing. We're here to talk about stocks. Chris has a really good thing that he messaged me about noon today, my time, and so we bought some stock today. We still have a crap ton of money left. We still have like a couple $100 that we need to buy, but yeah, I will hand it over to Chris and see where the stream takes us. It should be a good time.
All right. So, a lot of investors, especially on the retail side who are probably watching us, they usually just buy stocks and to some degree, maybe some options here and there if they really want to speculate. If you want to be a good investor, you got to learn how to make money in good markets, bad markets, sideways markets, and all the different asset classes that currently exist. One of the asset classes that doesn't get spoken about very much, but actually provides for great returns if you can get in at a good time, is preferred equity. Preferred equity is kind of like a cross between debt and equity itself, right? So there's two things to it. So there's benefits there, and there's actually some downsides too. One of the biggest benefits is the liquidity aspect. When it comes to bonds are not very liquid. Most of the time people buy bonds, they hold them in an account and they don't really trade very much. With preferred equity, that's also true, but there is a little bit more volatility and there's actually a little bit more of an open market. So right now I just called Matt and said, hey, listen, Matt, this preferred equity is a good investment. Can you buy some for the portfolio? So Matt's like, okay. 2 seconds. He was able to get onto his brokerage and, which is Fidelity, and just buy it. It wasn't a very hard process. With bonds, it could be a little bit more complicated. Sometimes you have to actually have to go through a bond desk. Then there's certain bonds that are very limited because you're not allowed to buy them because of all the regulatory requirements around who's able to buy these things. So with preferred equity, it's actually pretty simple. It's literally doing the same thing that you normally would do with just a stock. But you get some really good returns out of it if you know what you're doing. So the one that we ended up buying today, Matt, if you want to show the screen real quick.
Do you want me to share the portfolio screen?
Yeah. Show the portfolio real quick. Yeah.
Where did I put it? I will put it over here. Very good.
Okay. Just zoom in a little bit. Okay. So the one that we just bought is right here, BPYPM. Okay. This is Brookfield Property Partners, LP. This is their preferred equity. Their actual regular stock was privatized by the company itself. They just took the company private. But the preferred equity is still out there, right? And the preferred equity is where I see some value. So let's first figure out how preferred equity is priced. What are some of the things that mean around it? If you could click on that for me. Actually, you can't. This is a screenshot. Okay.
It's a screenshot.
Let me share my screen real quick. Sorry.
For sure. But it's fun. Okay. This is the sort of arbitrage that Chris loves, right? Specifically around the bond market, but even in the preferred share market. And you'll see why just in a second.
Yeah. So if you look at this, these are the different cumulative preferred equity that Brookfield has. Brookfield is a giant asset manager, and they have a division that does nothing but real estate. So if you go to some of the buildings around New York City, around the world, around the country, Brookfield is the main owner behind these buildings and these anything real estate wise. Let me just bring up what they own real quick, because I think the first thing we have to do before we go into why we invested in it,
they own a lot of different stuff, man.
Yeah, they're all over the world. In terms of asset management, they've got $501 billion of assets in North America, $56 billion in South America, and you can see here, these are all the kinds of things that they own. They're in all sorts of different industries, so it's not like they just own one specific type of what is that thing called? business, but they have tons and tons of businesses that are out there. So the one that I'm mostly interested right now is their hold on, property business. It's taken a pretty significant hit once they privatized the stock itself. That was no longer tradable. But what is tradable right now is their preferred equity. Now, the way that preferred equity works is that, let's say a company wants to build a new building, and they need money. Well, they could do one of two things. They can raise it by issuing bonds, right? Where they go out into the market and say, hey, we will issue bonds, and those bonds are payable semi-annually, and this is the price that we'll pay. So that's one, right? And there's different layers of bonds too. They have secured bonds that are first lien, and then you have second lien bonds. Then
Can
you
you
have
explain what the lien means,
bonds.
or do you want me to explain what the lien part means?
No, you explain it. Go ahead.
So basically, the bond in structuring, right, where people basically have preferred in case like a company, in terms of risk and a company going bankrupt, bonds will be the first kind of thing that gets paid out, right? So technically, why when a company goes bankrupt, the stock goes to zero, it's because technically they don't owe you anything, right? You just own a percentage of the company. And so all that money, they liquidate all the pens, pencils, printers, car equipment, anything that's in the company. In this particular case, they liquidate all the real estate for Brookfield in the case that it would go bankrupt. And they would distribute all that back to the bondholders. And those guys would be the ones that actually end up holding all the equity in the case of it going bankrupt. And that's where they might do like a Chapter 11, where they're kind of figuring out all that stuff. But and then preferred shares is actually a second tier. And this is a good graphic.
Yeah. So if you could imagine, if you can imagine a pyramid, the pyramid at the top, these are the people who own the most secured part of the debt stack. So essentially, if let's say the company were to go bankrupt, these guys would get paid out first. After these guys get paid out, then comes subordinated debt. And then after that, you would get the preferred equity holders would get paid out. And then last but not least would be common equity people. So usually with the market capitalization of most companies, you're going to have most of the equity sitting here in common equity, but then you also have preferred equity and subordinated and senior debt that's up there. Preferred equity is something that it gives you this bond-like return, but this equity-like liquidity. That's the biggest benefit. And so some of the biggest users of preferred equity is something that if you want to loan money to a company, but you also want to make sure that you are ahead of a lot of the other people, like the other investors, you can do that. One of the most famous cases of using preferred equity is Warren Buffett when he did a deal with Goldman Sachs during the Great Financial Crisis. Whereby he said to Goldman, hey, listen, I don't mind giving you this money, right? Because you are a reputable bank. You're going to be worth it. But I'm not going to be subordinated to the point where I'm just going to be an equity holder. I want to make sure I get my money. And so what Buffett did essentially was say, hey, we are going to give you this money, but you're going to pay us the entire time. So right. Buffett gave $5 billion right now to Goldman Sachs at the time and said, I want $5 billion worth of preferred shares with a dividend of 10% on those shares, right? And I want an additional 4.35% in warrants. So if in the future I wanted to buy this company shares, I could buy those company shares. So, Goldman Sachs was super desperate at the time, so they actually made the deal. And so Warren Buffett's pricing for their warrants was right here. So Buffett actually announced his preferred equity stake when it was around here. So even though everything crashed, Buffett came out whole, and Buffett was getting paid 10% of the money that he lent out for free, basically. And then on top of it, because of those warrants, he got the equity side. So when Goldman Sachs recovered and went up in value, he can exercise those warrants. It's almost like a long dated call option and basically buy up the shares super cheap and then sell them in the open market. So he made a crap ton of money like this. So, preferred equity is a way that you can sort of leverage your capital to invest in companies but do it in a way that it guarantees you a little bit more safety than just buying their stock outright. Because if the stock goes to zero, that's really bad. That means you lost all your money. That means that now the bondholders, especially at the top, are going to get paid first, then second and third. And if there's anything left over, which usually by that time there's nothing left over, then you would get paid. So a lot of times preferred equity is a little bit more safer. So Brookfield right now has their preferred equity that's still listed. It's a 6 point, the one that we bought, let me just show you. The one that we bought is a preferred equity that pays 6.5% interest, but that's on the face value of the preferred equity itself. So right now, the face value of that preferred equity position is $25, right? So when this was listed, and let me just go to BPYPM. When this was originally listed, it came out at $25, right? So essentially, when a preferred equity offering comes out, this is the face value that it has. And usually it trades a little bit close to it. But what ended up happening was after 2022, we had the interest rates rising. So right now people said, wait a second, the business around property ownership is not so good. And a 6.5% return is not acceptable to me. So a lot of people saw the risk and said, I don't want to be in this. So they sold it off, and they sold it off to a degree that it was actually down to the lowest point, which was around $11.68 a couple of weeks ago. So this one's been on my radar, but I didn't pull the trigger until now because I needed to know that in the future, the interest rates were going to be going down. And so one of the key themes that I have in my investing style right now that I'm projecting for 2024 and 25 is I want to buy heavily leveraged companies that have a ton of cash flow, because I know what's going to happen is the cash flow itself will end up being that giant buffer that gets me paid the entire time to wait. And on top of it, if interest rates start to go down again, which in all likelihood, we're looking at 6 different cuts in 2024, that means that now these bonds are going to be, these preferred equity shares are going to end up trading back at 25 again, because the business overall makes more sense. So if we look at the research here, let me just bring it up. You can see here, their distributions are pretty much all the time. They're always going to have their distributions. And unlike a company that pays dividends can be paused. Dividends can say, hey, the company says, hey, we don't want to pay dividends anymore. We want to save our money. We want to save this capital. They don't have to pay anymore. With preferred equity, they don't have that choice. They have to pay, or they can pause it, but eventually, which is why they have cumulative, it means that it will accumulate. So let's say they missed a bond payment, or they missed a payment. So they usually pay on the first day of March, June, September, and December. If they say, hey, listen, we don't want to pay for March, that won't just disappear. So if they cut the dividend, that just goes to zero. You don't get anything. But with a cumulative preferred equity position, that amount that you were supposed to get paid gets carried over into the next month, and then the next month, and the next month, until they restart the what is that thing called? The interest payments, your distribution payments that you're supposed to get. The other thing is, you can't pay a dividend to your shareholders before paying these guys first.
Right.
That's the other thing. So if right now a company says, hey, I want to invest in this stock, if Brookfield wants to pay, if they wants to issue new shares that have a dividend, they won't be able to, because they'll say, hey, listen, first you got to pay off these cumulative debt holders. By the way, Brookfield has not missed a single payment, and they're not going to miss a single payment. Now, the interesting thing about it, though, is this right here, which is their annual filings and their quarterly filings. This is where you need to do a little bit more in-depth research. And this is where guys like me come in, and I look at the actual security itself, but I also look at hold on one second. Sorry. Let me just bring up the 10. God damn it. Reports, quarterly reports. Okay. So here, you guys can still see my screen, right?
Yep.
Okay. So this is the quarterly report for Brookfield. And so if we look at,
I can't see that screen.
Oh, sorry. Let me just share. share. There you go. Can you see that?
Yes.
So this is the parent company itself. And these are all the different items that they're generating, how much it costs them, how much income they're getting. Because remember, they still own these properties and they lease them out to different companies, organizations, etc. So this is all the data that gets reported out. But the most important data to me was this right here, their debt obligations. Because we're investing in a debt-like security, we want to see like, hey, what's going on? Why is this company or this preferred equity being sold so much? And it's actually kind of obvious. Look right here. They have a giant maturity wall coming up in 2024, right? $20 billion of debt is coming due in 2024. So most people would look at this and freak out and say, hey man, I don't want to be in a company. What if they can't meet their debt obligations? What's going to happen? And a lot of their income has been sapped because of all the, let me just go to their revenue. Sorry. Let's see. Hold on a second. Interest. Come on. Where's the damn interest payments? Okay. So you see right here, their interest payments. Can you see this, Matt?
Yes.
Last year, before the rate rises really started to take effect, they were paying about $2 billion in interest charges, right? This year, they extended that to 1.5 billion in additional interest charges. And this is with, because they have a lot of floating rate debt. So this is the part that a lot of people looked at and said, holy shit, this is bad. So if you look at the data from last year, right, the last year data, you can see that they made a net income of about $2.2 billion in 9 months, which means they were easily able to pay all of the expenses that they had, like, and the interest payments on their preferred equity, right? Now, if you look at their net income, they're actually lost about 1.2 billion. Now, this is why the company was the preferred equity was sold off. But here's the key thing. Now that we know that we're going to have lower interest rates in the future, that means that this number is going to turn back into this number. And if it turns back into this number, that means that they have additional money that they're actually able to use to keep supporting that distribution payment. And so preferred equity gives you that safety and security of being on top of the common equity holders. But then also, as things go back to normal again, people are going to say, hey, wait a second, I want this yield. I want a 6.5% yield. Technically speaking, because we're buying it at a discount at $12, we ended up getting a 12.5% return on our money just for holding it. And this is in perpetuity. This is not in a what is that thing called? Hey, listen, we can just like close it out at any time. And if they did want to call back this money and say, hey, we want to call this back, the company, they would have to pay us $25 per share. And right now, we just paid $13.01 for it. I think you paid for it, right? I have it at 12 something because I bought it early. But the point is, you want to get a nice 13% return in perpetuity, right? In a tax sheltered account. But then on top of it, once the market recovers, this thing will go back to 25 again, in which case we'll double our money, so our yield to maturity is like crazy. So.
Yeah, I think that's because basically that 6.25% is based off that $25 face value, right? So until they want to call this back, we bought it at basically 50% off, so double that 6.25%, and that's what we're getting. So on a monthly basis, or I guess on a quarterly basis, really, we're going to get a 3% payback on our capital until it either goes belly up or they redeem the shares, which is great, right? And what we could do in reality is, time can come along, just like Chris said, it goes up to $20 or $22 a share because things are becoming more normal again. And if we want to, we could just take that money and put it into something else, or we could just keep collecting that 3% on our investment, right? I mean, at that point, it's going to be closer to a 7-8% yield if it goes to $20. But on our investment, we're still going to be making 3% every single quarter or 12% per year, which is great. I mean, where else can you do that unless, and this is all assuming that everything continues to go up and to the right, and the company stays solvent. So in that respect, I mean, it seems as though these guys are big, right? This would be almost not necessarily as bad as if Goldman went out of business, but it'd be Chris always fucking does that. But it would be almost as like bad as if Goldman went out of business, because huge company, great asset evaluations, great investment income that they generate. And so if a Brookfield goes belly up, then we have bigger problems out in the world. Hot Chris.
Yep. Yeah, close the wrong window. Yeah. I mean, this sucks for people who bought this shit at 25 at like preferred like face value. And now they're just happy, like, oh, I'm getting a 6% return. And it's guys like us, like we were patient. We saw the opportunity. We bought it at 50% off. So
well, I've been looking for good, because I've been looking for bonds in companies that, so something like this, right? Where you're getting an income, and eventually as things ease, then it'll get better. So I've been looking at it in companies that are really stretched right now in terms of being hit and impacted by debt. Like Verizon's probably one to look at. I know we talked about looking at a Verizon one a couple weeks ago, and then NextEra Energy is one where people are trying to sell off the debt. So any company where it's pretty debt heavy right now that's been impacted by these higher interest rates, it's probably a company that either might have preferred shares or has debt that is cheaper that could potentially, you've done it in the past. So that's kind of the thought process. But what was I going to say? That's a lie. I have had yielding preferred equity before. I think it was like a Wells Fargo or something like that. And I bought it at like 22 or 23 bucks before and sold it for a little bit of arbitrage when it back to 25, but it was yielding like 5 or 6%. But there's also something for maybe some of the other investors that's out there, and maybe this is a good thing to share, maybe it's not, but this is something, let me share my screen, that I've invested in the past, specifically when I'm focusing on dividend income. So this might not necessarily be good for the long-term equity holder, but this is a conglomerate of preferred companies. So if you're looking for companies to potentially invest in, maybe here's a good list to start with and kind of comb through this. So maybe you could look at the prospectus of what's in here, because this probably has, how many holdings does this thing have? Does it say? It doesn't say. It just has the top 10, but this yields about 7-8% on its own. Granted, you can see that over time it's been kind of steadily losing a little bit of capital, but it's never been that bad up until recently, where interest rates started getting pretty rough. So just like Brookfield, right? So it kind of hovers around this $38 to $40 range. This goes back to the financial crisis. So there's that associated with that, but it's stabilized after that, hanging out in the $38 to $40 range. And then obviously it's been impacted since interest rates started to rise. So this could be another opportunity in an arbitrage play if people look into it and potentially see, oh shit, well, this is $30. It could go back to 36, 37, 38 in some due time if interest rates kind of come back a little bit and retrace back to something that's more normal. I don't think it'll go back down to zero interest rate policy that we're seeing, but something that's a little bit more in line with what's reasonable for an economy that's kind of at a 2% GDP growth and is at a 2 to 2.5% inflation on an annualized basis, right? So probably something in the low to mid threes for right now, unless some sort of for a Fed funds rate, as opposed to what we're at, which is like 5.25 personally. But some people in the chat earlier asked a little bit about TLT, Chris, and I know we've talked about it a billion times.
Well, bring up our portfolio real quick with all the companies that we have, and then we can explain it from there, because this way people understand the value.
Yeah. Sorry.
Yeah, you can put TLT up there if you want.
No, let me stop. Present, share screen, entire screen. There we go. So there's that. So TLT is It's 3 down from the bottom.
So if you see TLT right now is up almost 8.3% in a month, right? Why? Well, if you're buying the long bond, which is a fixed return that you're going to be getting for 20-year bond, what happens is if interest rates start to go down, that those long dated bonds end up getting bought up, which means those values go up, which means TLT, which is the ETF that underlies that has underlying bonds for that specific thing, that goes up in value. So that's why TLT right now is getting higher. And also TLT pays a dividend, based on all the bonds that it underlyingly owns right now. So we just got a payment, I think last week or something for
From
that.
Which one? TLT? Right? It's in the middle of the month.
Yeah. So if you look at all the other ones that we have, this is the theme that me and Matt have basically come up with going into 2024, which is finding these higher yielding companies that have a lot of debt because they just had a lot of capex, but they also have a lot of cash flow to cover those obligations. And so once the interest rates start to go down and inflation starts to come down, which is what is happening, those companies are going to get bid up and we're going to make good money on them. AMT, from when I bought it, is up almost 20%. Crown Castle's up, I think, 30%. And that's on top. And that's not even including the dividends that we're probably going to be getting soon. SLG is the same story. So
yeah, SLG has been a great performer in here. But back when Chris was kind of talking about it, we bought TLT not at the bottom, but we were pretty dang close. So when it started to kind of be on this move, let me just get my pointer out here. When it started to get on this move around here towards the end of October, early November, that's when we kind of bought in. So at this point, TLT had already started to bottom. And you've only see the yields. This is basically the yield of the 20-year treasury looking out, only decline from there. And so what that means is basically the value of the previous bonds, because interest rates were increasing so rapidly and they were holding pretty much a rolling, I guess, bucket of 20-year treasuries. The value of those treasuries that they were holding that may have been bought a year or 2 years ago were basically getting trashed because the interest rates of those things were lower. And why would you buy a 20-year treasury that's yielding 3% if you could go out to the open market and buy it at 4%? So what you're seeing is now that we're reversing, those treasuries aren't necessarily being as trashed as much. The rolling treasuries that are kind of in there are being valued closer to what it is today. And so that's why the value of that is continuing to go up. Now, if let's just say we hit a zero interest rate policy again, and the interest rates for US, the 20-year treasury go back down to like 2.5%, 3% like they were, then TLT is going to go into the mid
$150.
Yeah, 150, $140. And that's what happened in 2019, 2020, where people were investing it to the moon and they were thinking, oh, well, this is a great investment. Bonds are great. Because as long as yields are going down over time, which is why since the 80s up until about a year ago, bonds have been a phenomenal investment, because that entire time, maybe that's prudent for me to kind of bring up. Bond yields since 1980, and let's bring up an image. So this is since 1990, but maybe this is a better one to. This will be fine. You can see that, Chris, or no?
Yeah, I can see it.
Didn't get out of my face. Here we go. What's it showing? Let me stop sharing that and share this. This is a bigger photo of it. So most people always talked about this 60-40 portfolio or something like that. Well, that makes a lot of sense when bonds are going on a low and to the right sort of yield loss, right? Where bonds are getting and yielding less and less over time, because the previous bond that was yielding 10, 12%, everyone wants a 10, 12% yielding bond. Hell, if you had $1 million, you'd be making 100 grand a year and you'd be able to live sustainably on that bond, right? Versus today's bonds, you're looking at 3-4%. Well, obviously you're going to want those other bonds, right? So the value of those bonds skyrockets because you're trying to equilibrate what today's yields are versus what it was before. So the value of this bond that was yielding 10%, if you're only yielding 5%, is basically going to double in value because that person basically has a 10% yielding bond, but on the open market, you can only get 5% yielding bonds. So you're trying to bid up the price of this 10% yielding bond just to make it equal, right? And so it made sense when everything was kind of going lower in terms of yield. We've gotten to a place where we're literally at zero, and we've been in a zero interest rate policy for so long to the point where over the past few years, 18 months, 2 years, we're actually at a point where we're increasing rates to a point where it's above 0%. And that's where you're starting to see things like TLT get massively impacted because no longer, unless you start to go negative, no longer do you have the opportunity to grow the value of that face value of that bond. So, well, I guess not the face value, but just the open market value of that bond. And so when it gets back to talking about the liquidity issues that all these bonds had, these banks had in the March-April timeframe, all of that was because they were holding 1 year, 2 year treasury bonds, and the value of those bonds went from yielding, and this is a good talking point here, CNBC, let's just put the 2 year treasury in here. And this is what I'm kind of referring to. Jesus, is it really up to that? This is why banks absolutely got obliterated. And Chris, step in if I misspeak here. They basically were yielding literally next to nothing because of the zero interest rate policies that were out just because of the pandemic. So, and this was like this, if you look, pretty much from 2008 and then we started to raise back in 2018, and then we started cutting again because in 2018, things were starting to look like we were potentially slowing down and hitting some sort of recession. But looking over the past 5 years, basically since the pandemic, people were buying bonds, 2 year bonds, 1 year bonds. Well, what happens when you're buying a 1-2 year bond and it's only yielding 0.2%, and next thing you know, it's yielding 4%? The value of the bonds that you had just bought are nothing. They're worthless. Because why would you buy this 0.2% yielding bond? We can now go into the open market and buy this 2%, 3% bond. And that's why you started to have all these liquidity issues. All these companies had negative assets or negative book values because basically the value of what they were owning was just completely outweighed by the fact that the values of them were worthless. I think I misspoke a little bit there, but basically the paper that these companies were holding was just worthless. And that's why you had to open up the ATM at the Fed earlier this year to be able to have people allowed to get them through the liquidity issues that they were having, because it's not a problem that they held those bonds. The problem is when you look at it from a mark-to-market accounting perspective, they have to write them down. So it kind of goes back to what Chris was talking about with Brookfield. It's like they might have lost $2 billion on paper in net income, but that's a non-cash event, right? That might just be the assets and the valuations that they have on their commercial real estate or their energy assets. And when things go well and the market turns back around, they can write up those things. What's really important to look at, and this is why it's always important to look at all three statements when you're looking at a quarterly financials in 10Q, is because you could look at a net income statement and there's going to be depreciation, amortization, non-cash items in there. And so a prime example of this is if you look at probably the 2Q or 3Q earnings report for Berkshire Hathaway, you would have been like, oh my God, this company is losing money hand over fist. But in reality, if you were to look at the cash flow statement, Berkshire was printing money. Their railroads were doing great, all these companies. And all it was the fact that they had a stock portfolio, which is worth $300 billion. And it went from $300 billion in first quarter of 2022 to $250 billion at the end of 2Q 2022. So what does that mean? They had to really literally write off $50 billion of net income, but they didn't actually lose it. It's just a mark-to-market accounting problem. So that's literally a little bit maybe about how the liquidity crunch with some of these small banks and regional banks happened earlier this year, and hopefully that makes a little bit more sense. But it all plays a factor, right? So what we're talking about is now the reversal of that, where we've kind of hit this peak, 4.5%-5% yielding bonds. Now we're going to slightly see that come back down to 3% or 3.5%. So something that's a little bit more reasonable. And so now you're going to see that basically retracement of some of these things. Now, retracement can be good or bad, but in this case, we're seeing the retracement of the yield. So that's positive for small cap stocks. It's positive for a lot of these companies like Brookfield that Chris is talking about that got whacked because of their yields have to be higher on the bonds that they're reissuing to pay back that $20 billion of front wall that's coming through. Verizon's going to have to, everyone's afraid that Verizon's going to default, but in reality, they've been able to have the cash flow to be able to keep that debt at bay, if not pay off a lot of that debt. Now the yields that they're going to be issuing for the future bonds are going to be cheaper than what they just issued. So that's the sort of stuff that we're talking about. And that's kind of the macroeconomic events that has been causing a little bit of this rally, because the past 4 or 5 months, you've been seeing 10 years going towards 5%. And everyone's just sitting there like, holy shit, when is this going to stop? Right? It was going on its way to 5%. It blew through 5%. People thought maybe it's going to go to 5.5%, 6%. People were sitting there like, I don't know what's going to happen. And it's been relieved over the past 2-3 months to the point where we've had this little bit of rally since the end of October timeframe. So that hopefully gives you guys a little bit of feedback. Chris, did I say anything wrong there?
Oh, you got it. You hit it right on the head, man. So, this is a great time to understand how the debt markets work, how interest rates impact a lot of businesses, and also some of the other macro changes that are happening also. So I'm seeing, employees are losing their ability to say, no, I'm only going to work remote. So a lot of companies are bringing a lot of people back to the offices. So the offices are going to be occupied, leases are going to get signed. Those leases, as they get signed and buildings get bought up, that brings value back to the commercial real estate market. And because the commercial real estate market is such a big thing, it could actually force the Fed to lower interest rates sooner to avoid a catastrophe. And so that's what I'm banking on, So I don't think the commercial real estate market is going to go anywhere further lower than it is. And that was the bet that I made on SLG when it was in the $20 range. And that's why we are up 100% on our position for SLG.
Yeah, I'm curious. What am I up? Last I checked, I was up let me just double check. I'm not sharing.
And then on top of it, we've been collecting those fat monthly dividend payments.
Yeah, man. I'm up at least 80%. Let me just double check.
Good times.
Yeah, I can't complain with it, man. I have covered calls for January for $50. And my hope is that it doesn't blow through that. But even if it does, I don't think it will. I don't think it will either. But even if it does, 85% is what I'm up. But that might be with reinvested dividends. Do I reinvest dividends or do I take cash?
So
I reinvested dividends.
So Jordan right now said it's negative free cash flow per share. Yes, they do have negative free cash flow, but it's very, very small amount of negative free cash flow. You have to go to their disposition. So because they have so many assets, they can clear out a few of those assets, even at a loss, and they're still able to pay off all their stuff without any issue. The point that we're making the bet on right now is that next year, interest rates are going to be going down. And if interest rates go down, Brookfield will be able to refinance a lot of that debt at super cheap prices. That's the thing with the free cash flow. Right now, the free cash flow is being impacted by the higher interest rates that they currently are undergoing. So this is almost like you're investing in a lower rate environment going forward, So like I said, Brookfield has a lot of levers that they can pull. So I think you're on mute.
Yeah, sorry. I haven't looked at Simon Property Group in a while. This gentleman in the chat's talking about it. It looks like it's actually trading at not really a depressed valuation. So I'm not really seeing a huge value here, unless this person picked it up during the pandemic or something like that. But I'd be curious to see what the price to funds from option. I haven't done any research on SPG in a long time. Maybe it is trading at a fair value, but
Mhm.
it's always one of those stocks, at least in the real estate business, that is probably trading at a premium. And to me, the fact that maybe it's been on a run over the past few months because of the interest rates are kind of looking in the other direction, but I guess it's up close to 30%. So
So Dean is asking, did we clarify why? Yeah, Brookfield has a lot of debt in 2024 because that's just how they structured their debt. There's no in particular reason why. They probably just said, hey, listen, we have a low rate environment. We want to make sure we're not paying a lot. And so instead of being a little bit more prudent with it, they didn't do a lot of longer term debt. And they have a maturity wall coming up next year. And this is one of the reasons why it's trading at such a big discount.
right,
But that's, like I said, that's the benefit for us. The
right,
benefit for us is that, number one, there is a lot of equity that's there that we don't have to worry about. Basically, if the company is going to get, what's the word, like, let's say it goes out of business, let's say it goes bankrupt, there's a lot of assets that can be sold off to pay a lot of those debt obligations, right? But they won't even need to get there, in my opinion. So, like I said, it's a bet. This is a bet against a rising rate environment. It's actually going to go the other way.
Curious if realty income recovered a little bit. Okay. I remember everyone was starting to freak out again when a month or two ago it started dipping below 50. So good for people, because I know a lot of people love realty income. I'm staying away from it. I sold mid 50s or something like that. I had held it for a long time, but it's got an Airbnb rental there. So yeah, I mean, you have to. Sometimes the market gives you these opportunities, right? And I'm really curious to see, 5 years down the road, do we have to go back to a zero interest rate policy to steer off of some sort of recession? Because if that's the case, then a lot of these things like real estate investment trusts and all these other companies that are so reliant on debt are probably going to moon, because the value and the interest expense that they're going to have to pay is just going to decrease over time. I mean, you saw so much debt being taken on by some companies like Apple, for example. It literally took on debt instead of giving out their cash because it was so cheap. Like, why would you pay out the cash in your treasury if you're only getting a 1% or 1.5% yield on your debt? Like, it just doesn't make sense, because that's technically, you could take that on, and by the time a year goes away, like the interest rate is literally as much of as inflation is. So it just doesn't make sense where you'd be taking on debt at, say, 7-8%, but at 1%, I mean, money is literally free, especially if you're able to invest that at 20-30% returns or operating margin like Apple probably has. Anyway, I'm trying to think, is there any other preferred companies that I've owned in the past? I don't know.
Would not touch Tells. Would not touch it with a 10-foot pole, man. Don't do it.
So I'm curious, Chris. Sorry, go ahead. I didn't mean to cut you off.
No, that's Tellurian's baby bonds. Not gonna touch them.
Really?
Yeah.
Let me pull those up.
I don't even know if it's on Robinhood.
Nah, it's not on Robinhood.
Yeah,
so that's a preferred. It's Tellurian preferred is the.
Nope, I don't want that gas, baby. You can have all the gas that Tellurian has. I don't want them. I don't want it.
That's the thing. It's got a lot of gas, but no way to.
No.
To
they
export it.
They have upstream gas that they bought using some capital, but they issued these baby bonds, and I don't know, man. I'm good. I don't trust.
That's the thing. They have the gas, but they have no way to export it, right? And that's where the margin is, right? Yeah.
Yep.
Not many people are making a lot of money on selling gas in the United States. When you look worldwide, actually, I was looking at a really good graphic. It might have been. Actually, yeah, I was looking at this earlier because I was doing a little bit of research on Cheniere and what their price is compared to what their price could be compared to like Next or NEXT and stuff like that. So I was just doing a little bit of work. And where is their investor presentation? Where we work, Cheniere Energy.
You know who we need to get on here at one time? Stephen Fiorello, because I want him to go through ET with us one more time, because I'm looking at them and they seem like they actually missed on EPS, but they've had a pretty good run. Energy Transfer has been doing well. I don't know if
when it was the day before Thanksgiving, we had that 3-hour stream, and it was me, TJ, and that. And I think you had to leave a little early, understandably, because it was 3 hours. But he was supposed to do an article on ET that he had wrote that day. He wanted to promote it, and unfortunately, TJ came on and we just started talking about a whole bunch of other things. And he said, "Let's talk about it at a different time." But we could easily. I'll see if he can come on tomorrow.
Not a bad idea.
I'll poke him.
If you guys haven't followed Stephen Fiorello on Seeking Alpha, highly encourage you guys to do it. This is his Seeking Alpha account. If you guys are looking for a great way to generate income and maybe possibly retire early one day, this is the guy you want to talk to, man. Or if you just want to play a nice game of World of Warcraft, because Steven loves World of Warcraft, which I never get, but I don't know.
What was I going to say? Let me share this again. So talking about Teleron again. So the benefit of having LNG in your portfolio is you could buy it or find it at, let's just say, a $3 price at Henry Hub in the United States, and be able to, let me zoom in, use that to sell to, let me see, is it zoomed in? Okay. Sell to TTF, which is the European market, or JKM, which is the Japan market. And that's why in 2022, sorry, I know that this graphic is a little bit zoomed out. 2022, this spiked up because of everything that was going on in Russia. Supply chains were all messed up. And so you had a huge supply shortage going on in Europe because they were shutting down the pipeline. The Nord Stream pipeline got bombed, all that sort of stuff that led to shortages in 2022 for gas. Now it's kind of normalized back to a normal price, but you can still see between this teal, this blue, and this red, teal being Henry Hub, which is what we have internally in the United States. This is the margin you're getting by liquefying the natural gas in the United States and sending it to Europe or sending it to Japan. So when you're talking about all these terminals and things of the like, for like Teleron or NEXT or anything like that, that's the margin that they're going after. That's why they're putting billions upon billions of dollars into this investment for infrastructure, because then they could literally send several BCF of gas and make a margin, huge margins off of that opportunity. Now, Tellurian, for example, Tellurian, I don't know how it's pronounced, but
Tellurian.
I'm thinking of Telluride, which is a car. Tellurian, they have upstream production, which means they're able to get supply gas at, say, $2, $3 an MCF, as you would for, let's just say, buying it on the open market in Henry Hub prices in the United States. But they don't actually have a facility yet to be able to capture that margin between the blue and the teal and the red that we were showing. It's a hope and a prayer that they'll be able to get one sanctioned to be able to do that, but they're just not there yet. So until that point, it's all literally a speculation. Versus like NEXT, it's a different story, right? Because NEXT, they're actually building it. Will they be on time? Chris and I were talking about it the other day. The first 3 trains at NEXT, while they are sanctioned, they're actually being constructed, unlike what's going on at Tellurian. The first 3 trains aren't necessarily super profitable for NEXT. They've needed to not dilute, but divest or farm down to people like Total. They've had some Middle East investors. They've had a few other people join. Where the real money is going to be made is, I think, in train 4 and 5, where they're going to own a lot more and a higher percentage. And that's where the distributable cash flow is supposed to come in for train 4 and 5. Now, I think you're going to see a big spike for NEXT if they say that they're going to sanction the 4th train in middle to late 2024. Big spike is probably not the word I should use. A spike or, and you're going to see some potential influx of capital and the share price might increase in NEXT if they sanction that 4th train, because it's going to have a higher equity value, and that's going to help with the distributable cash flow for the business. So, for example, and this is based off their slides, so you kind of have to take them with a grain of salt. They said they're going to have $200 to $300 million in distributable cash flow at NEXT with the first 3 trains. So you think about it's $1 billion company, $200 to $300 million in distributable cash flow. So once it's actually up and running, you're looking at a price to DCF or distributable cash flow of 3 to 4 times, let's just say, versus, because it's a $1.2 billion company market cap right now, versus if they sanction trains 4 and 5, they were looking at about $1 billion to $1.25 billion per year in distributable cash flow. So then you're basically paying a price to 1-to-1 for price to distributable cash flow. But that obviously requires a lot more capital going forward, right? You still have to get to 2026, 2027 before first gas of the first 3 trains. Then there's the 4th and 5th trains that have to be, 1, sanctioned, 2, built, and then 3rd come online. So you've gotten a little bit of the way on a very unprofitable part or less profitable piece in NEXT, which is you've sanctioned it, you've started to actually put shovels in the ground, versus Tellurian, they have all the gas that they might need, so it's very low feed gas costs, so their margins could be huge, but they haven't even sanctioned the ability or gotten the permitting even, have they, to be able to put shovels in the ground?
I don't think for 4 and 5 they have. I know they have 1, 2, and 3 already done. Like FERC has already gone through everything. So, but to be fair, I don't think 4 and 5 is going to have an issue. So,
yeah, I don't think so. Anyway, sorry, I was looking at it the other day, so I just wanted to walk through that piece. Trying to think.
Yeah, next is a long play, but if it works out okay, it could 20x on us, So it's one of those things that we might have to consider just turning it into a coffee stock. You know what I mean? It's like
that's what I started doing. I'll tell you what I'm doing in my Robinhood. So there's a couple stocks where I throw $50 a pay into it, and that's the problem, because sometimes I'm like, oh, $50 a pay. Next thing you know, I have 8 or 10 different stocks I'm doing it, and it ends up being a couple $100, and I'm like, shit, what am I doing? And you're like, oh shit, I'm putting $1,000 into this shit. So I looked, and I was putting some into Epsilera, $50 a pay, so it's $100 a month. And then I was like, you know what? I was like, let me do 35 and 35. So at NEXT, I'm doing 25 in NEXT per pay, and then 35 in Epsilera per pay on Robinhood. So those will be little trinkets. So my thought process was, I was like, all right, I'm putting $50 a month into NEXT. If it does actually go 10x, then that $50 a month will turn into 500. Not only that, but I'll also probably get that money back in dividends or cash flow. So that's the real hope, right? That's where I care about, because I'm if I put it.
Can you imagine buying that you had bought, let's say Cheniere, right? This is LNG from here. Oh, you had? Oh.
No, I had CQP, which CQP only doubled, because that's a dividend play. This is where I'm a little bit confused, because oh my god, I actually have it up. Their structure and how they have all their businesses is just really weird.
Yeah, but dude, look at this. If you had bought $3, let's say every month, a couple of bucks here, a couple of bucks there, you never would have noticed. And once they got their trains up and running, bro, look at the dividend that you would have got just on a quarterly basis without doing anything. You would have got the entire balance that you were $1,000. If you had put $1,000, you would be getting close to what's the damn share? What's the dividend on this LNG?
I said it was 1%.
It's 1%, but I'm saying, what is it? It's like 44 cents a quarter. So you would have gotten, let's say you put, like
Our yield on
$2. You
cost would have been
amazing, right? So
yeah, but the thing is there's flavors for both people, right? There's CQP, which is more of like the partnership ownership, where I think you own a little bit more of Corpus Christi, and you're getting a little bit more yield. So I think that's like a 6% yield or something like that. Let me look it up. CQP, and that's the one that I had owned, and I was, because at the time I was very much a dividend investor. And so you can see that the returns aren't nearly as much, but that depends on what you need, right? If you need that income. So I think I own this in like the $20-$30 range, because I was investing in this stuff back in like 2015, 2016. So it's doubled, but the yield
if you look at it in 2008, this thing had gone down to like $5, the CQP position. $5. And if you think about it, what's the current dividend that they're paying? Like
6, almost 7%.
No, I'm saying that, but I'm saying what's the dollar amount? So I wanted to see what your total return on cost would be.
Let me see, 58 times. Let's just say 58 times.
Their distribution, I'm looking at it right now, is about 25 cents, and then they have 75. So per year, I think it's almost $2.
I'm seeing $4. Because if you're looking at,
it's a 4. You're right. It's $4.
Yeah. So I mean, you'd be getting if you were to buy in the $4 or $5 range, you'd be getting a 80%, 90% dividend on cost.
That means if you had put $10,000 in this, you would get $10,000 a year in fucking return, on top of all the capital appreciation, which is.
And that's the hope. Like I want to find a company like that. That'd be great. And the thing is, though, is like people can get caught. So what I want to make sure that people don't do, because I see some people do this. I, for example, have a 380% return on my BHP shares, right? And so some people might say it's just like, well, that's paying I think it's like a 10% yield or something like that. But let's just say
right now it's 5.5.
5%. Okay, so let's just say I'm getting a 15 to 20% yield on cost on that stock, right? People might say, well, I'm getting a 15 to 20% yield. It's like, yes, but that's on your initial investment, right? I get it. It feels good. But you have to consider, is owning that 5% yield that you just quoted for BHP better than any other stock out there? And the problem with yield on cost sometimes is like, if you still want to own the stock, I get it, right? But sometimes I've seen some people hold on to shitty stocks because their yield on cost is good and they've held it for 20 years or something like that, when they should be selling that position off because it's dying and move it into something else. But they get caught up with that yield on cost number. And I get it, because I've had BHP where it's spun off assets, it's paid special dividends on multiple occasions because of asset divestments. They used to have a big petroleum business. They sold that. Part of it to Woodside, part of it to BP.
Kinder Morgan had that CO2 business that was super profitable for them. Remember that?
Yeah.
And then all of a sudden, that business no longer mattered as much. And literally, Kinder Morgan's never really come back out that much since,
Yeah. So it's interesting. I mean, you have to think, like, a lot of people will talk about yield on cost, and I love it too, right? Because I love looking at that BHP. Why wouldn't you want to own BHP? It's one of the premier natural resource companies in the world. And I just happened to buy it when a perfect storm happened in 2015. I wish I put 10,000 or 10 times as much money into it, because we'd have probably a different conversation. I'd probably be in the Maldives, but it wouldn't have been that much. It would have turned it into like $100,000. It wouldn't have been that much, but Maldives one time, not all the time. But anyway, it just makes you think a little bit about getting caught up sometimes in some of these particulars. Like sometimes I think that people, they're smart enough to kind of understand and jump to conclusions, but they're not smart enough, or they don't know enough yet to realize they don't know anything at all. And that isn't necessarily specific about dividends, but that's just me. Like, that's just what I've realized in general. I'll get someplace where I'm like, there's no way I'm going to lose. right? Like writing cash secured puts in 2021 going into 2022. Well, it's like, well, the stock market can turn over, right? And
Yeah.
when that happens, you're going to be put a bunch of shit that hopefully you're writing on stocks that you want. Because if you don't want those stocks, then you're probably going to wholesale them as soon as they get put to you. And next thing you know, you're eating a shit ton of capital losses that you didn't think was ever going to happen because the Fed was putting in $80 billion to $100 billion of money into the economy every single month, and nothing could happen except for the market to go up and to the right during that time. So you think you get smart enough sometimes, and then reality sometimes will just smack you in the face. And so I just want people to be cautious about some of these things.
All right, dude. That's a 1 hour's up.
Yeah.
I am probably gonna head to work. Always a pleasure, brother, man.
Always.
Thank you for this preferred shares. We got to figure out what to do with some of that other liquidity that we have. Maybe we'll buy a little bit more of Brookfield. You know, take a look, see what you think. Maybe we'll go up a little higher. How much do we have? Additional cash?
5 shares. I mean, we have remaining capital. We have $292 left.
Okay, we could split it up evenly among some of the other stuff. But like I said, a 12% yield right now, dude, that's perfect. With 100% return potential, I'll take it. You know.
Yeah. So yeah, maybe because that's only $65, so maybe we could up that 1 or 2 more shares, and then Verizon is only 10% of the portfolio.
Yeah.
TLT. Yeah.
Like I said,
I'll send you the screenshot.
Sounds good. Like I said, you guys are being on this journey with us, you know, to see how long it takes us to get to 100 grand. That'll be very interesting to see. Maybe in a couple of years, maybe in 3 years, maybe in 2.
Yeah, I mean, it all depends on the super chats. It all depends on the memberships. It all depends on all that stuff. I mean, you think about it, we're $99,000 away. If we're able to average $300 a month, we're only 27 and a half years away from getting there.
We better get those gains, brother.
Am I doing my math right? Because 99,000 divided by 300, that's 330 months, and then divide that by 12. So yeah, 27 and a half.
Zoe's like, you should just copy this portfolio. Bro, one day Chris Patel will launch an ETF.
Oh, okay? I would. This could be our ETF event, because I was literally looking it up the other day. I was like, how much capital do you need? How much? I mean, it could very well be that you and I end up having a Chris Patel ETF and a Matt Money ETF, all stemming from what we're looking at here. Because I actually wanted to talk to you about that, but you already mentioned it. So
yeah, no, dude, an ETF would be perfect. You know, this way you guys will take all the guesswork out. Just be like, hey guys, join us. This is what we did. This is the portfolio moves that we're making. You know, this is the total return potential that you could have. Ticker symbol cash. Yeah, if it's not already taken.
I don't know. I forget what I was looking at. Let me see. Cash. No, cash is not taken. I'm surprised, but there's so many fees associated with though. So you'd have to make sure that you have people.
ETFs are expensive. Like ETFs to run them, even though I looked at some that were white glove, like out of the box ETFs, they run pretty expensive. But so you need at least 5 to 10 mil under assets under management to get there. You know, before you can really make that. So you need a million plus of your own capital, and then another like 5 to 10 from investors to really get in there. And then after that, you'd have to do a decent what is that thing called? Expense ratio just to pay for the upkeep, you know.
Yeah.
So
and that's the thing. It's like, and that's why I think sometimes you have companies that'll be like, well, if you only invest this much, they have loading fees, right? Where it's like, you only invest this much, we're going to charge you this much expense ratio. If you put in more, we'll charge you less of an expense ratio. And that's something that I probably do with people. It's just like, you only want to put a couple $100 in, I'm probably going to charge you more. But then you have to keep track of that. It's much easier to just say whatever assets under management is what it is. But anyway,
maybe we can network with some rich people and be like, I like what you're doing. I will invest and they'll get an equity piece of the expenses, you know, basically. So me and you would do the actual stock picking. They would end up getting a portion. They would invest their capital into the ETF and into the into the equity portion, and then we could sell it as a equity, and so they
Well,
would get a piece of the gains.
Mine would probably be a lot more, I don't want to say simpler than yours. Mine would be very, maybe we should talk about it tomorrow. Maybe we should just sit down and say, how would we structure our ETFs if we both had one? Maybe that's our topic.
Okay, not bad. Yeah. I like that. Garcia's like degen. but he spelled it wrong. It would be degen like that. There you go. Lunar Excursion got it right. That's the one.
Yeah, I mean,
all right.
You could do a lot of things, man. That's the thing is when you do an ETF, you could literally do whatever the hell you want. You could literally just have it all cash and write cash secured puts, distribute a part of the income associated with it.
The problem is the bigger you get, the harder it is to do all those things. Because if you think about it, like, look, if you have 10 million in assets, right? Let's say you have $1 million worth of stock in something, dude. How many contracts you have to fucking write to make that thing?
Well, look at that. We just added $350 to this thing, and we're like, well, what do we do?
I mean, this is small, man.
This is, but we still have to have a conversation about it. You know what I mean?
Yeah.
Anyway,
yeah.
Cool, brother. Well, I appreciate that. We'll have a good conversation tomorrow.
Later.
Cheers, all.